Subscribe to my channel Report Stock.
Welcome to the deep dive. Today we're taking a closer look at a real giant of the fast food industry, McDonald's.
A titan, for sure.
Exactly. We've just gotten our hands on their Q2 2025 financial results. And well, our mission here is to unpack what drove their, honestly, quite surprising triumph.
Right, from the earnings jump to that bump in the stock price?
Yeah, and figure out what this tells you, our listener, about, the global consumer and maybe the playbook for these big established brands.
Oh.
So it's quite a story. I mean, just imagine a company this huge, this global, not just meeting Wall Street expectations, but actually beating them across the board.
That's what McDonald's did, yeah, Q2 2025.
And bam, the shares jumped 3.5% in pre-market trading, like right after the news hit.
Yeah.
So it really makes you wonder, what is cooking behind those golden arches?
Yeah, it's definitely a compelling story, broad strength, really, especially when you think about some of the challenges they faced before. The headline numbers themselves, they paint a pretty clear picture.
Okay, let's dive into those numbers then. So McDonald's reported adjusted earnings per share EPS of $3.19.
Right.
Now, okay, that sounds like maybe a small beat over the Zacks consensus estimate of $3.15. But it's actually a really healthy 7.4% increase year over year. Why does a 4-cent beat matter so much in this case?
Well, that seems small, right? 4 cents on adjusted EPS. But it's actually a really powerful signal.
Okay.
Because adjusted earnings, they strip out those one-off items, gives analysts a cleaner look at the core operations.
Right, to underline the business.
Exactly. So that 4-cent difference, it tells the market McDonald's either managed costs even better or pulled in more revenue than, even the optimistic forecasts.
Oh, okay.
It signals really good operational control, and that feeds right into investor confidence, hence the stock bump we saw.
Got it. And it wasn't just the earnings side. Their quarterly net revenues. Right. They hit $6,843 million.
Yeah, over $6.8 billion.
Which beat the consensus mark, was it $6,714 million?
Yeah.
And that's a solid 5% increase compared to last year. So top line, bottom line, both growing year over year.
Robust growth, definitely.
So how did they do it? What were the key ingredients here?
Well, connecting this back, McDonald's pointed to a few critical strategic things.
Yeah.
They saw an increase in comparable guest counts, getting more people through the door. That's always, fundamental.
Sure.
But how they did it is interesting. Strong value offerings that really resonated globally.
Value. Always key for them.
Especially now, right? Lots of places are raising prices because of inflation. McDonald's seems to have found that that sweet spot.
With bundles and loyalty stuff.
Exactly. Targeted value bundles, the loyalty programs, they make customers feel like they're getting a real deal, even if some costs are up. It's about perceived value, not just low price.
That's a really good distinction. Perceived value. Okay, beyond that, they also mentioned impactful marketing and menu innovation.
Right. The usual suspects, but clearly effective this time.
I always wonder with a brand like McDonald's, is it harder to invent totally new hits or just keep the excitement going for the classics? Do new items risk messing with the core?
That's a really good question. It's definitely a balancing act.
Yeah.
It's often a mix. New items create buzz, sure. But a huge part of their recent success, they said, came from strategic tech investments.
The digital side.
And rapid digital expansion, yeah. Making things more convenient, boosting engagement through all the channels.
Like the app, mobile ordering.
Think about it, yeah. Smooth mobile ordering, personalized offers in the app, making the drive-through faster. It just makes it easier for people to, choose McDonald's. Makes the existing stuff more appealing.
Okay, now here's where it gets really interesting. Looking at where the money's actually coming from inside the McDonald's system.
Right, the breakdown.
If you break down the sales,
Yeah.
company-operated restaurants reported sales of $2.5 billion, which is actually flat year over year.
Yeah, flat, which might sound a bit concerning initially, but...
And that's only part of the picture, isn't it?
Exactly. That flatness is massively offset by the strength in their franchise model.
Okay, how'd they do?
Sales at franchise-operated restaurants hit $4.2 billion. That's up an impressive 7% year over year.
Wow, 7%.
Yeah, it just shows the power of that franchise-heavy model, It's asset-light for McDonald's corporate, gives them really consistent high-margin revenue. It's a huge part of why they're so profitable.
Makes sense. And speaking of profitability, something else jumped out at me. This huge spike in other revenues.
Oh, yeah.
Up 92% year over year to $172 million. What on earth is driving that? Is it like beyond burgers and fries?
That is a fascinating catch. 92% is huge.
Right.
Other revenues can be a bit of a mixed bag, but for McDonald's, it often includes things like licensing their brand, maybe fees from their digital platforms.
Oh, like tech partnerships?
Could be, or even income from their massive real estate portfolio. That kind of jump suggests they're really succeeding in diversifying revenue streams, finding income beyond just the restaurant sales.
Smart move for the long term.
Very smart. More stability, more growth path.
Okay, that makes a lot of sense.
Yeah.
And thinking about long-term health, if you ask any analyst about the key metric for a fast food business, what do they always point to?
Oh, it's got to be comparable sales, comps.
Exactly. Comps.
Yeah.
Why is that the golden metric?
Because it measures sales growth at existing restaurants. So it takes out the noise from just opening new stores. It shows the underlying health.
And how did McDonald's do globally on comps?
Globally, the comps rose 3.8% in Q2, which is a really significant turnaround from the 1% decline they saw in the same quarter last year.
Okay, 3.8%, and that beat estimates too, right?
Yeah, beat the 2.4% estimate quite handily. A very solid win. Shows strong underlying demand.
And it's interesting when you break that down by region in the U.S.
In the U.S., comps were up 2.5%. Again, reversing a decline from last year, which was 0.7%.
And they mentioned it was helped by positive check growth. What does that mean exactly? Why is it important?
Positive check growth. It's not just more people spending money. It means each customer, on average, is spending more.
So bigger orders.
Yeah, maybe adding that extra drink, upgrading fries, choosing a higher-priced item. It shows their upsell strategies, maybe new premium offerings are actually working. They're boosting revenue per visit, not just getting more visits.
And that 2.5% in the U.S. also beat estimates slightly, didn't it?
Just slightly, yeah. Beat the 2.4% estimate, shows continued strength right here at home.
And the international picture looked pretty good, too.
Very good. Their international operated market segment, that's like the UK, France, Germany, where they run things more directly.
Right.
Comps there jumped 4%. A really sharp contrast to the 1.1% decline a year ago.
Wow, 4%.
And what's really impressive is this growth came from positive comps across all the markets in that segment, not just one or two carrying the load. Beat the 2% estimate there, too.
Okay, broad strength internationally. And the other international segment, the licensed ones.
The international developmental license segment, yeah.
Yeah.
Even stronger, up 5.6%.
5.6.
Huge turnaround from a 1.3% decline last year. This is where they licensed the brand to local operators.
And Japan was mentioned.
Japan led the way, yeah. But again, they stressed positive comps across all global regions in this segment, too. It really shows how adaptable their strategy is. Leverages local know-how, but keeps that global strength.
Okay, so strong sales picture.
Yeah.
What about the costs? Operating health? Profitability?
Well, their total operating costs and expenses came in at $3.6 billion. That was up only a modest 1% year over year.
Only 1%. That seems pretty well controlled, especially with inflation these days.
Very well controlled, which
Yeah.
does raise the question, right? Does that tight cost control risk impacting, the customer experience or quality down the line?
Yeah, is there a trade-off we should be watching?
It's always a valid concern in food service.
Yeah, like that.
But with McDonald's, their scale, their sophisticated supply chain, it lets them find efficiencies, often behind the scenes.
Not necessarily cutting corners the customer sees.
Hopefully not, and the results suggest they're managing it. Because with costs only up 1%, their operating income jumped 11% year over year, $3.2 billion.
11%. Nice.
And net income followed right along, $2.3 billion, also up 11% year over year.
Okay.
So those are strong signs of a healthy operation, finding that balance, at least for now.
So really impressive quarter for McDonald's. But let's put it in context. How does this position them in the wider industry? They currently have a Zacks rank #3, which is a hold.
Right.
For our listeners, can you quickly explain what a Zacks rank is and why might they be a hold even after such a strong quarter?
Sure. The Zacks rank is basically a system that tracks how analysts are revising their earnings estimates for a company.
So it's forward-looking.
Exactly. It's not just about this quarter's performance, but what analysts expect next. So even with McDonald's great results, that hold rank suggests analysts aren't, rushing to massively upgrade their future earnings forecasts.
Maybe they see growth moderating or less upside compared to peers.
Could be. Maybe they see fewer immediate growth catalysts compared to some others, or just expect a more steady, moderate path ahead. It gives you that comparative angle.
That's helpful. So while McDonald's did great, it's always good to compare. Are there other stocks in the Zacks retail restaurants industry that are currently ranked higher?
Yeah, definitely. For example, BJ's Restaurants BJRI currently has a Zacks rank #1. That's a strong buy.
Okay, BJ's, how are they looking?
They've had an impressive run, up 20.1% in the past year, and their 2025 estimates, sales projected up 3.6%, but EPS projected up a huge 130.8%.
Whoa, 130% EPS growth. That suggests a big turnaround or acceleration.
Something significant is expected there, yeah. Then you've got Yumly, brands by Yum, parent of KFC, Pizza Hut, Taco Bell.
Right.
There is Zacks Rang #2, a buy, up 4% year to date. Their 2025 estimate shows sales growth of 6.9% and EPS growth of 9.5%. Solid number.
Okay, anyone else?
And the Cheesecake Factory cake, also a Zacks Rank #2 buy.
Cheesecake Factory.
Okay. They've gained 15.6% in the last 6 months. And their 2025 estimates point to sales growth of 5.5% and EPS growth of 1.7%.
Interesting. So a diverse picture in the sector.
Definitely shows different growth stories playing out.
So wrapping this up, McDonald's Q2 really does highlight, the power of hitting that value note, pushing digital engagement, and just consistent global execution.
Absolutely. It's a fascinating case study.
Yeah, for you as someone watching these trends, their success isn't just about McDonald's bottom line, is it? It says something about how these huge established brands can still innovate and stay relevant even when things are shifting. Resilience.
So looking at their success, especially that franchise growth and the global comps, what does this tell you about the future for big brands like McDonald's and fast food, maybe compared to the growth paths projected for some of those peers we mentioned?
That's the big question, isn't it?
And maybe more pointedly for our listeners to think about, what specific strategies do you think will keep driving success in this incredibly competitive market going forward?
Subscribe to my channel Report Stock.